Index funds are great, but what if just tracking the market isn't enough? Today's investors want more resilience and more intelligence without paying the full price of active management. That's where multi factor passive investing comes in. Passive investing is simple, factor investing is powerful. Put them together and you get a strategy that's changing the way portfolios are built. I'm your host Ankita Verma, and welcome to this Outlook Money webinar on passive investing with a multi factor twist. And to help us decode this smarter approach, I'm joined by Umeshkumar, Head of ETF Sales at Mirae Asset Investment Managers India. Umesh, welcome to the show.
Thank you, Ankita. Thank you for having me on this show.
Okay, Umesh, let me start with the basics. We keep hearing this term smart beta. Sounds fancy, almost like a tech product. What exactly does it mean and why do we call it smart?
See, before understanding smart beta, let's first understand the beta concept first, because the beta is something which is important in this. So, what is beta? Beta is something which tells that how particular stock is behaving as compared to that underlying index. For example, if the market is the beta of a particular fund is say 1.1 or 1.5, it means if market goes by 10, that particular fund will go up by 15 or go down by similarly. So the beta is means the volatility of that particular fund vis-a-vis the index. Now, using that beta concept smartly comes in a smart beta under the smart beta concept, because we all know that markets behave certainly in certain cycles. So we don't know which cycle is going to be when and how the particular fund which I'm holding in my portfolio will behave in that particular certain market cycle. So using those patterns of or those factors while selecting a particular stock, so that is there are different factors for it. So the using those factors comes under how smartly you are using the beta, which can help end of the day to your portfolio in terms of enhancing returns or maybe giving you lesser drawdowns.
So it's really about adding intelligence to the plain index. So most people think you either go active, with a fund manager or go passive and track the index. What does smart beta really fit between these two?
Yeah, I would say that it's not about active versus passive. I think you very well said also. If you want to, you feel you understand that the funds are doing their jobs and they are doing well in terms of outperforming the underlying indices. I think good to go, and it's advised to go with active fund management in that sense. And we can still see that in many pockets, fund managers are doing pretty well. So in that particular fund houses or that particular funds, you can always look for buying active also. But there are strategies, there are funds which are doing well when it comes to passive, because there are two things: either you outperform the market or you want to be with the market. So being with the market, smart beta or not smart beta per se, I mean say passive, will help you in terms of as an investor to be with the market. Now being with the market, how to outperform the broader indices. Like to give an example, if I have a Nifty 500 in my portfolio, and we all agree that most of the funds are benchmark against Nifty 500 or some or other indices which comes out of Nifty 500 only. So if I have to outperform Nifty 500, or if I aspire to outperform Nifty 500 through the passive up approach, then I would say smart beta can help to some extent in terms of achieving that goal that I want to outperform this, or either the overall Nifty 500 or some specific indices out of that Nifty 500. So from that perspective, I would say smart beta fits into very well into the portfolio, where it comes in between active and passive, because it is highly active in some cases, like alpha strategy, which is highly active. The rebalancing happens every quarter and you will see many stocks coming in, going out. So from that perspective, the activeness is very high being in passive. So it's like, you can say it is like, passively active, you can say, because in being in passive you can get a gist of actively management fund also. And since you are coming from a passive platform, so you will be having all the advantages of being passive. So I would place it this way: active plus smart beta plus passive. This is how you can you can build your portfolio.
So it's almost like the best of both worlds. Okay, coming to factor investing, they seem like filters on a shopping app, you know. Is that a fair way to explain factor investing, and how is it different from the traditional investing?
So, like if you look at any investment strategy for that matter, be it a actively managed fund or a passively managed fund or wherever, like in my portfolio and everybody's portfolio, we invest for returns, we invest for stability in our portfolio, we invest for our to fulfill our aspirations, to fulfill our goals. Now the returns comes mainly from stock selection, and we must be hearing these kind of words, I mean these kind of statements in the market, that this is a stock pickers market and all that. So why it is being said? Because it is purely depends upon how efficiently, how smartly you select a stock. Now smart beta comes and plays a very important role here, because when we talk about actively managed funds or active fund managers, they keep their factors in their mind, and they choose their the underlying stocks, keeping that thought process, or keeping that assessment in mind, or into their workbooks and all. But when it comes to passive, because all the stock picking criteria are being very well written beforehand and assigned with a particular factor. Now if I give an example, if you go for a say quality based factor, so the quality based factor will pick stocks on the basis of ROE, return on equity, debt to equity ratio of a particular stock, or EPS variability, in how the EPS is behaving for that particular company. So on these three parameters the stock selection will happen, because every parameter, a certain score will be given to that stock, and accordingly whichever company gets the maximum score and get the maximum out of it, or the top rank companies will be part of the index. So like quality, every factor has their own stock selection criteria. So from a factor perspective, this is something which you have been witnessing throughout your investment journey lately. But this from here onwards, if you start investing factor or a smart beta funds, means you know that what are the factors or parameters are being used while selecting that particular stock. Another important thing, when it comes to passively managed fund, the factors or rules are defined on that particular factor or a index, are there for a lifetime, till the time there is no change. So you as an investor, I know in that particular fund how the stocks will be selected, and that selection criteria will is going to stay in that particular index till the time I'm investor, or till the time that index is there.
So factors are basically filters investors use to tilt their portfolio in a smarter way. So for someone very new to this, what are the most common factors that fund managers actually use that may give us a, if you can, give us a real world example of each?
Yeah. Yeah, sure. So when I talk about factors, there are two kind of factors. One is macro factors, which are your inflation, your GDP, and all those factors we all hear day in day out, or read in newspapers, and or fund managers also speak about them. Now another side kind of factor is style factor. Now style factors are basically you can say micro factors, which helps in terms of selecting a particular stock, because macro factors give you an idea about the industry, about the economy, or about the particular industry or a sector. But when you go to micro, you will get to know that okay, which you zero down a particular company or that sector, within that sector which companies are doing well. Now in style factors, there are multiple factors like quality, as I just explained. Then there is low volatility. The factors, low volatility means the factors, the stocks selected under that factor will be focusing on those stocks which are lesser in terms of volatility as compared to the peer group. The selection happens purely on a standard deviation. Then the third is say momentum or alpha. So these two are factors which works well when markets are into some kind of trend. The selection happens when it comes to momentum. The selection happens on last 6 months or 1 year risk adjusted returns of that particular stocks, and the top scoring companies will be part of the index. And that then comes to alpha. Alpha, the selection happens again. It also similar to momentum, but the stock selection different. The selection happens purely on Jensen's alpha, where we look at that in terms of returns, returns. The companies which are doing well as compared to their peer will be part of that index. Now, then there are equal weight strategies, factors, which basically, as the name suggests, every stock of that underlying index will be weighing equally. So that's how basically it works well when there is a broad based rally, when the overall markets are growing, and you have exposure to all, say, Nifty or say BSE 200. So all BSE 200 companies are equally weighed in your portfolio. So when the index grows, you have exposure to the topmost company also and the lowest company also in BSE 200. So it's the kind of a strategy which works well. Then comes to value. Value is a strategy which works very well when markets are not doing good, like there is a downfall. That time we look at companies which are high in terms of value and price is lower, so then we find a value opportunity there. Those kind of companies are part of that index. The value, we have seen that it does very well when, especially when there is a recovery, when their markets are recovering from a deep correction. At that time, value driven companies which has higher value, ratios, or higher value scores, generally tend to do well. So this strategy works well there. So there are multiple said. Now you can do combination also, but every factor has a different stock picking approach, and every factor works well when there is different kind of market cycle in the market. So that's how it works.
I think great examples, quality, value, momentum. These are the terms people have heard of, but now they know how they actually work in funds. So, what's the real edge of mixing factors, Umesh? Instead of sticking to, just one, is it about consistency, risk control, or something else?
Markets are very, they behave weirdly in sometimes. They behave in certain manner sometimes, and we as an investor, we try to ride that rally or try to ride that downfall, in terms of which should impact my portfolio very less when it comes to downfall, and it should help my portfolio enhancing returns when there is a rally. So as an investor, it's very difficult for me to figure out what time, in what sort of market cycle I am into, because that is becoming very difficult sometimes. I mean, maybe fund managers can do, but for a retail investor, for a investor like me, it becomes really difficult. Now I want to, and I understand that market as an economy, India as an economy going to grow. We know that India is targeting certain rank in the world in terms of economy. If we reaches to that level, obviously your market will grow. Now we know market is certainly going to grow. We know that market, in the economy is going to reach to a certain level. During this journey, there will be hiccups, there will be positive side, negative side, everything. How to ride this journey from here till where we want to reach, that is where the smart beta comes in, because as I said, every smart beta factor has a different approach towards different market cycle. Now if I have a combination of few of them, I can be maybe assured or not assured, I may be maybe confident that okay, if there is a market cycle change, if markets move from one cycle to another cycle, since I have a combination of factors, then I can ride that movement also, and I can make sure that my portfolio is sailed through, it sails through according during that market cycle also. So it's a kind of doing a combination of, it is like saying that lately we all are health enthusiasts. We want to become more healthy. We are focusing on more different kind of foods and all that. So it is like a kind of similar kind of thing for your portfolio. If you want to look for a long lasting portfolio, if you want to look for a food portfolio which does well in every weather, so that's where I think having a multiple factors in your portfolio is like having multivitamins, your fiber or your protein, everything. So that's how it helps in terms of maintaining or building your portfolio for a long lasting period.
Right, so a more balanced all-weather strategy. Okay, imagine I'm a retail investor who's perfectly happy with my plain vanilla Nifty index fund. Why should I even bother looking at a factor based strategy? What's in it for me?
Yeah, fair question. Actually, if I talk about, say, how my portfolio has been doing for last, say, 5, 10 years, 15 years since I've started investing, I would say active fund managers done well, and few of them are still doing well. Index funds are doing well, while broad-based funds are doing well. But as I said, if I have an opportunity, if I know that the rule which is there in the market in particular factor can enhance my returns little bit of, because the when market, and lately we have seen that when market cycle turns, at that particular time a particular fund manager might not do well and some other fund manager might do well. Now we, though we have that kind of diversification in our portfolio, few of investors must have invested with one or two or three AMCs, then they know that different fund manager has different approach. This is what active can do. But from passive side, if you can want to be in the market and you want to compete with your existing active funds which are already there in your portfolio, for a retail investor I would say the market cycles are something which you can take charge of, and by these products you can at least get some idea or maybe get some push in your portfolio when it comes to say cycle change. So you have certain portfolio which is dependent upon active funds. We have certain portfolio which is into broad base. Now you can have certain portfolio which will be into smart beta. From a diversification point of view, this is going to help to every retail investors also. And since it's a new thing and new thing for India, not for world, so we have seen that every market in the world has different cycles. There are limitations. Sometimes you feel okay, markets is going nowhere. What to do now? But if you are into right factor at that time, and those kind of funds are there in your portfolio, you might be better off. And since the market, as I said, we are targeting a higher number from here from economic perspective, so market may behave weirdly also sometime. And that time, these kind of strategy for a retail investor also kind of good experience. It should be a good experience for the clients.
So, not about replacing the index fund, but more about getting a smarter layer on top for better risk adjusted returns.
Yeah, I mean, if the fund is doing well, like you always invest with a target. If you have a goal in mind, if you have a certain target in mind in terms of percentage returns or maybe something else, if that goal or that target is being achieved by existing invested fund and is doing well as per your expectations or beyond expectation, then there's no point changing it. I'm saying it is like getting future ready. It is like getting investing into companies. If tomorrow if market behaves badly or something else happens, at least I'm trying to cover up my portfolio behavior from here.
So, when you actually combine multiple factors in one fund, what does that unlock? Are we talking about better returns, lower risk, or just a smoother ride overall?
The idea is to go for a smoother ride. When you say smoother ride itself comes with a better returns and a lesser volatility, because the smoother ride can happen only when you have a portfolio which can give you a seamless ride despite there are a lot of movement in the market, ups and downs in the market. Having multi-factor, there is it's a good product. It should be there in the portfolio. Only challenge with investors used to be how to how to choose, which factor to choose. I mean, which cycle, which factor, how much, how to rebalance, and these are the questions which are there. But I'm saying for a plain vanilla investor also who don't want to get to these rebalancing everything, having multiple factors always does well. Historically, we have seen. There may be times, because as I said, every factor has a limitation also, because say in a correcting market, your alpha momentum might not do well, right? But some other factor will do well. So that's how it gives a perfect combination for your portfolio. Some or other factor will do well, and as a result, your overall return of your portfolio will be in line with expectations which you keep from the fund.
So, smoother ride across market cycles, that's what most investors are looking for. So, all right, time to bring this home. Tell us more about the Mirae Asset Multi-Factor Passive Fund of Fund. What's inside and how does it actually deliver on the multi-factor promise?
See, as I just mentioned that as an investor, I understood markets are different, cycles are different. Some other point, some other sector will do well, some other factor will do well. But as an investor, for me, it becomes very difficult to figure out that which factor to choose what time. I mean, how much should I allocate to momentum, or how much should I allocate to alpha or to quality or to value, and when to rebalance. As an investor, it's not my forte. My forte is I can just only choose the right fund and then stay invested in that. That's how we always tell investors to stay invested for a longer period. Now, if you get a product in your portfolio which gives you that comfort that okay, you invest in that fund and there are underlying different factors which will do well in different market cycles. Now the AMC, the fund house will take a call in terms of based on data, based on model, in terms of which factor going to do well or which factor is doing well purely depending upon data, and then accordingly the rebalancing, allocation, over allocation or under allocation will be done. So what we are trying to do here in this fund is we are trying to provide a solution to the investor who is looking for a smoother ride in different market cycles, who don't understand, who doesn't understand that okay, which cycle is good for my portfolio, which cycle is not good, how to change, when to change. That change, that portfolio, we will maneuver keeping in the market cycle in mind and based on a model. So it is like a solution, because as an investor I always look for a solution, because okay, I know markets are doing well, whatever understood, I just need a basic return or simple or a fixed return in my portfolio because I have goals in mind. Now how to achieve those goals? Now, so that's where this product can somewhere help me to ride the different market cycles smoothly. And there are 8 factors which we have defined right now, which where we'll be keeping a value. Maybe we'll be keeping alpha 30, we'll be keeping mid small momentum quality, small cap momentum quality, nifty 50 equal weight, or nifty 20 equal weight or 10 equal weight. We'll figure out few products we already have in our basket from our side, the products which are not available and we believe that those factors are doing well, or model is saying that you should allocate in those factors, maybe those factors we will buy from the market also. So we are trying to provide a solution, a full-fledged solution to in investor when it comes to factor. This product is a good to go product for any kind of investor, be it you are a retail or HNI or ultra HNI. For you, this product can be good for every investor needs.
So, a ready made solution for the investors. Let's dig a little deep into what's the exact investment strategy that keeps this fund on track.
So for that, what we have done is we have divided the entire market cycles into 4 regimes, I would say. First, we kept as a base regime, which is a good environment. I mean, into, you can say, the perfect world. The second is your moderate regime, which is like from base we are moving ahead, and we are moving towards moderate. And then third is a froth regime, where we believe that okay, things are moving ahead, or valuations towards the or valuation, the market might be entering into a fourth regime. And the fourth regime is a drawdown regime. So based on different data points which my model will give us, accordingly we will define, because we have put a range. Okay, this particular data point answer is there, it means this is, we are into this regime. So first the model will define which regime we are into, and then on the basis of that regime we have already defined our allocation. Say if we are into, say, base regime, what would be my allocation towards aggressive or towards conservative, you can say defensive funds. So as I said, multi alpha momentum, mid small momentum quality, small cap momentum quality, or value falls under aggressive, and maybe equal weight, low vol, these kind of products fell into conservative. So we'll see that we have already defined the market cycle. If we figure out the regime accordingly, we will allocate certain percentage which will predefined into those particular factor based funds. If the regime changes tomorrow, accordingly the rebalancing will happen. So the model will throw the data on a day to day basis. Accordingly, if there is a severe deviation from where the allocations are, we will be definitely going to rebal the portfolio basis on the model's recommendation.
So, basically, the discipline is rule based, which means no chasing themes. Here is something that I'm really curious about. Since this is a fund of funds, will you
Mhm.
only stick to Mirae's own ETFs, or would you be open to bringing in external products if they tick all the right boxes for you?
Yeah. See, the objective is to provide solution to the investor, and our priority will be to provide that solution. While providing that solution, if we figured out, or if we came to know that okay, there is particular factor which is doing well, and that fund is not here in our basket, so we'll go out and we will buy from the market, because priority is not to get whichever product we have. Priority is to give investor the desired return, or maybe the allocation which can fulfill the model requirement. So if needed, we'll go out. As I said, that few factors we have, which we have already defined, few of them we are not owning them. So those kind of factors we might go out and buy in the market, and most of them we already. So within that also, if you find that my fund should be better than the market, if market fund on the same factor is doing better than me, we might choose that fund also. So it will be pure, the priority is investor, the priority is to give solution to the investor, and which factor, which fund to choose, whether it's our own or outside, that's a secondary thing.
Yeah, I think that's very important assurance for the investor. Flexibility is really important. And my final question, if you had to describe the ideal investor for this fund, someone listening right now, who would be thinking, yeah, is this for me? So who would that be?
See, this is a product which is need of the hour, I would say, because this is not a product, this is a solution. Now, when it comes to solution, it can be good for everyone, like be it a retail investor, HNI, or ultra HNI, depending upon what sort of goals you keep in mind, what sort of goal you have kept while investing, whether the goals are nearing to achievement or you're still far behind them, behind to achieve those goals. So maybe keeping that thing in mind. But is there any specific investor segment for this product? I would say this is a product which is good for everyone, provided you should, because we will agree on two, three things. One, we all know that markets have different cycles. We all know that there are different factors which will choose funds depending upon market cycles, stocks depending on market cycles. We all know that the rebalancing is important, but we also agree that we don't have that much of capability to do it or to understand it. So let's keep it, fill it, shut it, forget it kind of. This is that kind of product where you can just invest, keep your goal in mind, invest in that fund, and maybe on a regular intervals keep on reviewing the fund as well as along with your rest of the portfolio, and keep in mind. So this is a good product for everyone, and we all agree that market is going to behave like this for a longer period of time, and I mean that's how we make returns. So keeping that in mind, I would say every investor should look at this fund, should consider this fund, should review whether this is getting or maybe complementing their risk profile or not. Accordingly, they should take a wise decision while investing into this one. But this is a good fund. First, maybe you won't find many products on this category which invest you into multiple factors that give you decent allocation or timely rebalancing into the fund.
I think that's a great way to put it. Umesh, thank you for your insights today. It was great having you with us.
Thank you, Ankita. Thank you so much for having me. Thanks to Outlook.
We started with a simple question. What if tracking the index isn't enough? Today, we learned how multi factor passive investing could be the smarter answer. At the end of the day, it's not about chasing returns, it's about building a portfolio that can weather cycles, and multi factor passive investing is one such approach. Thank you for joining us today, and stay tuned with Outlook Money for more such conversations.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.